Okay, today is going to be preparing a worksheet for a merchandising company. Different than a service company in that we have some different accounts. A couple of them we've talked about before, sales and purchases, and all the accounts associated with them, like the contra accounts, purchases, return and allowance, purchases, discount, sales, return and allowance, sales, discount, freight in. Today we're going to introduce a couple more. But before we do that, one of the accounts that we used at the beginning of the term for adjusting entries was what temporary account? Good. Income summary. We're still going to use that for closing entries, but the difference this time for a merchandising business is we're also going to use it for an adjusting entry. And it's actually a two-part adjusting entry. Okay? Again, the adjustments are for a periodic inventory system, using the account's purchases instead of merchandise inventory every time you buy merchandise. So again, ignore information for a perpetual system. That's not the system we're using for adjusting and closing entries. First of all, the new account that I was talking about is called merchandise inventory. What is merchandise inventory? Right, it's your products that you intend to sell for profit. So again, products that you intend to sell for profit is in an account called merchandise inventory. What kind of an account is merchandise inventory? It is an asset. It has value. It has value to you until you sell it, and then it becomes revenue. So merchandise inventory, an asset. Therefore, it starts with what kind of a balance? A debit. Excellent. And what we're going to learn to do is we'll start out with a beginning merchandise inventory at the beginning of the year or in the beginning of an accounting period. And then we're going to leave that merchandise inventory alone until we want to adjust it by doing what's called an inventory, physically counting what we have left to update that merchandise inventory account. Okay. Two-part process in adjusting merchandise inventory. Unlike before, where we just figured out what we had used, this process is twofold. The first step is to journalize a transaction that literally closes out the beginning balance in merchandise inventory. So let's say, for example, merchandise inventory had $20,000 in it. How would we close out that $20,000 balance in merchandise inventory? Credit it for $20,000. So if we're going to credit merchandise inventory for $20,000, what are we going to debit? Income summary. This is the time that temporary account, which we previously used only for closing entries, is going to be used to adjust merchandise inventory. So the first step is close out merchandise inventory by crediting it and debiting the same amount to income summary. Debit it to income summary. So that will zero out merchandise inventory, getting rid of that beginning balance. The next step is to put in what our physical inventory shows we have. So how would we do that? You're going to debit the asset, merchandise inventory, for whatever inventory count you find you have. So let's say it ended up being $15,000. The second part of our adjusting entry would be to debit merchandise inventory for $15,000. And what are we going to credit? Income summary, that temporary account. So debit merchandise inventory for ending inventory, and then credit income summary. So income summary is now going to hold a debit and a credit balance. And those debit and credit balances will show us the beginning inventory and the ending inventory, which we're going to need later to determine something called cost of goods sold. But for right now, just know it's a two-part adjusting entry. One to close out beginning inventory, and then the next journal entry to put in the new ending inventory. Now, another new adjustment is one I alluded to last week. When you think of a liability, what do you think of? What kind of accounts? Accounts payable, anything payable, salaries payable, wages payable, any kind of payables. There is an exception, and it is called unearned revenue. It is a liability account. Therefore, it has what type of a balance? Credit, still a credit. Just the name looks different. It records the receipt of payment for goods or services in advance of delivery. So, for example, if you were to sell maybe season tickets for a game, or let's do it this way. Maybe you were to sell concert tickets in advance, the way it's done, correct? You would receive the money for those tickets, but the concert hasn't happened yet. So as of right now, when you receive the money, have you earned that revenue? No. No. Therefore, for you, it is a liability, because if the concert doesn't happen, what should happen? Return the money. You should return the money. So until the concert happens, that is called unearned revenue, whatever name is associated with it. Could be unearned concert sales or something similar to that. So again, that is a liability until you actually earn it. So how would we record that sale of those concert tickets? If you received $200 for concert tickets, and we're the business selling them, what would we record it as? $200 to cash, because you're receiving the money, and $200 to whatever unearned revenue account name we have associated with it. Okay, does that make sense? Now, as time goes by and the concert happens, once it has happened, we need to adjust that liability account unearned revenue, because we have now earned it. We have now earned it. So let's first take a look at the journal entry. Again, cash gets debited and unearned revenue gets credited. That makes sense. That's when we receive the money for the revenue. Now, this, however, is an adjustment for when you actually earn that unearned revenue. We now want to reduce the liability, unearned revenue, or unearned rent in this case. So to reduce a liability, you must do what to it? Debit it. Remember, to reduce a liability, you debit it. And in that case, it has now been earned. Therefore, we can reflect it into the revenue account, whatever it may be called. In this case, it's called rental income. Rental income. So now it's recorded as actual revenue, and we've wiped out that liability because we've earned it. We've either, the rental time has passed or the concert has passed, whatever type of unearned revenue it is. And again, this is just showing the effect on T accounts. Initially, it's a liability, unearned rent, and then maybe as a month passes, we earn some of that. We can adjust it accordingly, showing it as income and then reducing that liability. That's how those accounts are impacted, or what we call adjusted. Now, where do adjustments get recorded? Well, we know the unofficial way is on the worksheet, so you're going to get a new, larger worksheet to work on from now on. You're going to see a lot more accounts listed than we did before, and you're going to see the incorporation of the new ones that we've mentioned. So let's take a look here. A list of accounts in order, and the trial balance amounts associated with them. Where are we going to get the trial balance amounts for these accounts? Okay, not from the T accounts. From the general journal. Actually, the general ledger. Not general journal, general ledger. You're going to go to your general ledger and find out the balances in the accounts. Or, if you've just done something else, you could get them from a post-closing trial balance also, which shows all of the accounts and their balances. Now, remember, for the purposes of your homework, my accounting lab requires you to do adjusting entry at the bottom if there's new accounts that aren't listed. But for the purposes of your mini practice set, what would you suggest that you do? I would just list them at all, because then they're in order, they're easy to find, and you don't get confused by extending those new added ones at the bottom. And because you don't have to enter it in my accounting lab, that's the way I would suggest doing it. But again, that's your choice. It's not wrong to do it the other way. It's just, I think, easier to do it that way. Okay, so let's take a look here, and let's figure out if we can determine what has happened. First of all, let's look at the A adjustments. The A adjustments. What do we have? Merchandise inventory of 310. Debit. What does that mean?
That's how much inventory you have left.
Okay, that's the ending inventory. And what's the one associated with it? Income summary. Remember, you have to have equal debits and credits for every adjustment. And what's B showing?
It's closing out the merchandise inventory.
Good. B is getting rid of the inventory that you started with. So look in your trial balance account here. You see the 600 shown on the trial balance? That's just closing out that amount by doing it here. And that means there has to be an associated debit. So what is the associated debit? Income summary. Good. So income summary is going to show what? Both your beginning and ending inventory. And remember that, because you're going to need it later. Income summary shows both beginning and ending inventory. Now, look at C. What do we have? Insurance expense. Debit and credit goes to what? Prepaid insurance. That's adjusting the prepaid insurance that we've used, just like before. So you're expensing it out, and you're reducing the asset prepaid insurance. And D, what's it showing? Depreciation. And what can you depreciate? Equipment. Automobiles. Office equipment. So long-term assets only, not current assets, but long-term assets. So we're going to debit the expense, depreciation expense, specifically for equipment. And what are we going to credit? We're going to credit equipment? Yes, the contra account, accumulated depreciation. Do not reduce the asset itself. Reduce the contra account that goes with it. Remember that one. Now E. Which one does this one reflect? Wages. Okay, so wages earned by putting it as a debit to wages expense, and crediting wages payable, meaning we haven't paid them. Employees have earned some wages, but we have not paid them yet, so therefore we're incurring a liability by crediting wages payable. Could be called salaries payable, could be called wages and salaries payable, whatever account title is given to it. So, any questions on those adjustments? Again, the big changes are only merchandise inventory, which is a two-part adjustment, closing out the beginning, and then putting in the ending. And unearned revenue means earning part of that prepaid revenue. So we're paid before we provided the product, the service, whatever it is we're providing. Now, this next extension to the worksheet looks pretty similar to before, with one exception. So let's see if somebody can find it. What looks different on here? Basically, what we're taking is the trial balance amounts and looking at the adjustment and either adding or subtracting to them to come up with a new what's called adjusted trial balance. That's true for everything except one account. And which account is it? Income summary. What have we done with income summary? We have taken both of the amounts shown in the adjustment column, the 600 and 310, and brought both of them over. Why? Why would we do that? Why wouldn't we just come up with a balance in that account, which would be a 290 debit? Why? Okay, one part is so you can see it, but why do you need to see it? Because when we do our income summary now, we're going to have to determine something called cost of goods sold, and in determining that amount, you need to know both the beginning and ending inventory. And since you can take all the information on the worksheet to do financials, both of those have to be reflected here. So again, this is the only account that you're going to extend both the debit and credit adjustment to the adjusted trial balance columns. Again, I repeat, it's the only one you're going to extend both of them over to the adjusted trial balance. The rest of them, you're just going to get a running balance of it.
So, with the merchandise inventory, you just take the 310 and move it over? Not worrying about really the beginning balance?
Correct. You're only looking at the ending balance because that's all that matters now. You've closed out the beginning, and now you have what you have left. And that ending merchandise inventory balance will become your new beginning balance the next year. Now, here we go some more. Using those adjusted trial balance columns, we then create income statement and balance sheet just like we did before. But let's take a look at the changes. First of all, you begin with income summary and below for the income statement, so that's the same. But again, what are we bringing over for income summary? Both the debit and credit balance for income summary, because we need to know both beginning and ending inventory. So both of them get brought over. The rest, it's just the running balance, just like we did before. So the only change again for the income statement columns is that you bring over both balances for income summary. Charles?
There's supposed to be a 600 for merchandise inventory in the credit. On the balance sheet? On the balance sheet.
No.
You've already closed out.
No, it's you closed out the beginning, so you put in the ending. So for the income statement, like we did before, we're just adding up our debit column and our credit column. Are they going to agree? Probably not, because that would mean no profit but no loss. You add them both up, you find the difference, add it to the lower amount, and that becomes either your net income or your net loss. How do you know which?
If it's more money, then you need net income.
If it goes in the debit column, it's a net income. If it goes in the credit.
Good. If your expenses or those on the debit side exceed those on the credit, then you know that you have lost money. But if the opposite is true, you know you've made money. Now, and the other way to determine this is this. Look at the balance sheet. Again, we transfer those accounts above income summary to the balance sheet. And we add those up. And if on the income statement we have a debit added below the totals, what must we do on the balance sheet columns? Add it as a credit. If you're crediting the balance sheet, that means it's impacting capital. Is that going to make your capital go up or down? Up. So if you made a profit as a debit, of course it makes sense that you're going to increase capital. And again, they should balance after the end. So if you get through your income statement and figure your net income or loss and plug it into your balance sheet and it's still not working, you've done something wrong. So go back and refigure. But again, on the balance sheet for merchandise inventory, what are we reflecting here now for our permanent accounts? The ending merchandise inventory, which will then become the beginning merchandise inventory after we've done all closing entries. So it's what we physically found to be the inventory at the end. Now, this information here is just some brief introduction. We're going to go to this in far more detail on Thursday. First of all, what is COGS, or often called just CGS? Cost of goods sold. What kind of accounts have we identified in the past as cost accounts? Purchases, return and allowance, those are called cost accounts. And notice that we have whatever we started with in inventory, we're going to add net purchases. And how do you arrive at net purchases? How do you get from gross purchases? Good. It's purchases minus purchases return and allowance minus purchase discount equals net purchases. So even though that's only showing net purchases, that's how you arrive at net purchases. Purchases minus return and allowance minus discounts equals net purchases. So if you add those net purchases plus any freight associated with those purchases, you get something called cost of goods available for sale. Okay? And again, we're going to review this in far more detail in next chapter because this is a section of the new expanded classified income statement. Now, how do you arrive at net sales? Sales minus sales return and allowance minus sales discount equals net sales. In cost of goods sold, we're going to go through the whole process next time, starting with beginning inventory. And once we get through cost of goods sold, which is the cost of all the product that we're going to sell, we still have to subtract all those expenses that we have associated with operating our business, which are called operating expenses, to arrive at what's called a net profit. So we're going to have to add those also. In addition to operating expenses, would you have any other expenses? Possibly, and we're going to go through those too, because those will be identified separately. So you may have other expenses besides those required for the business, or those required for the operation, I should say, of the business. Okay, again, net sales in a T-shell. We've said it before. It's the same as net purchases, but using different accounts. Sales minus sales return allowance minus sales discount equals net sales. If you do not have one or the other, you just don't include it. You only list it if it's actual has a balance. And this computation, as shown, is going to occur on your income statement. How did we start an income statement before? With the caption revenue, correct? And then we listed how much was in revenue. Now instead we're going to list sales, the gross amount, subtract returns and allowance and discounts to arrive at something called net sales before we can go on to the cost of goods sold section. So again, net sales is determined this way. And again, to go back to cost of goods sold, we take beginning inventory, what we started with at the beginning of the period or the year. We're going to add to it our net purchases to get our goods available for sale, and then we have to subtract any inventory we have left to determine how much did it cost us to sell what we sold in that net sales. So cost of goods sold.